This is Alex. Alex earned 100 euros from selling products to Switzerland. He places his newly acquired euros in his local bank, Rodribank. This is William. He also earned 100 euros and he also places the money in the bank. As a result, Rodribank now has 200 euros in its safe. A customer, Alenna, is looking for a loan to buy a new house. Rodribank has money in the safe, so the bank is willing to lend her money. But how much? Should it lend 200 euros? They can't. In this country, the central bank is forcing all banks to keep 10% of their customer deposits as reserves. This means that Rodribank can only lend 90% of the new 200 euros placed by Alex and William. That equals 180 euros. Alenna takes the 180 euros. She goes to see Richard, who is selling the house. They make a deal, and Richard gets the 180 euros from the sale of the house. Richard then goes to the Rodribank and places the money there. Now Rodribank can use that money to lend it to a new customer. How much of it? Since the reserve requirements of 10% have not changed, the bank can lend 90% of the new deposit, which equals 162 euros. Notice how out of an initial deposit of 200 euros from Alex and William, the economy has now gained 200 euros plus 180 euros lent to Alenna plus 162 euros, which equals 542 euros. If we run the cycle an infinite number of times, the economy will have generated 2000 euros in new money out of the initial injection of 200 euros. The larger the proportion of deposits that banks need to keep in their safe, their reserves, the smaller is the amount that the economy eventually generates. Therefore, the reserves requirements is a tool that central banks have to affect the money supply in the economy.